Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Cem Karsan for a Show Us Your Portfolio discussion. Cem shares how he views investing his own portfolio, taking his experiences as a trader and managing risk, to his views on the macro landscape and the secular trends he believes will matter in the long run. His portfolio positioning is unique, and Cem eats his own cooking by investing heavily in his own options and uncorrelated strategies. I think investors of all type can learn a lot from this discussion. As always, thank you for listening. Please enjoy this discussion with Kai Volatility's Cem Karsan. This episode is brought to you by Alpha Architect for Advisors. Whether you're an established firm or just starting out, you know the right systems can be the difference maker to achieving your growth goals. That's why Alpha Architect now offers a suite of turnkey model portfolios that can be customized to fit your practice. Built on Alpha Architect's decades of rigorous academic research, our model portfolios aim to systematize portfolio management so that you can spend less time tinkering with funds and more time finding your next great client. Systemize today to save time tomorrow. That's building with conviction. That's Alpha Architect for Advisors. To learn more about Alpha Architect's model portfolios and to schedule a consultation, visit advisors.alphaarchitect.com/models. That's advisors, ADVISORS, alphaarchitect.com/models. Alpha Architect for Advisors, built with conviction. Hi, Cem. Thanks for coming back on with us.
Great to be here. I had a wonderful conversation last time. Looking forward to continuing it.
Yeah, so Jack and I were talking. We've done 200 podcast episodes, and your episode we did with you in July of last year is actually the most viewed individual interview episode we've done.
Boom. I'm kind of a big deal, guys. Big deal.
So hopefully,
no, I appreciate that. Was a fun conversation. If people didn't listen to it, they should go back and listen to it, because I really enjoyed that.
But today we wanted to do something different with you, and we wanted to talk about your personal portfolio and the way that you've developed your own investment strategy. Talking about how you sort of view investing, some of the things that might be a little bit more unique, I think, given that what you do at your firm with options and just maybe the way you view the markets. But hopefully this is a good informative discussion that our audience will learn a lot from and other investors will be interested in.
Yeah, awesome. Let's do it.
So, I mean, maybe to start, let's start at a high level, which is, when you think about your investments, what do you think are the biggest overarching long-term goals that you're looking to achieve?
So, my roots are in the market making world, right? And so why do I start there is, when I started in this business, I didn't start from a perspective of how do I buy, assets at a cheap price, or how do I get beta in the portfolio and dollar cost average in. It really came from a relative value risk basis. How can I extract edge, right? And that's a very different kind of world. I think to a person, every person who is a market maker for an extensive period is a good risk manager. They have to be. The way they look at risk is very different. They look at it because if you're taking on liquidity, not by choice, putting on positions, but taking on liquidity, you have to be able to look at relative value and see where the risks are and really manage a portfolio. And generally, there's a decent amount of gross leverage in these market making portfolios, as you might imagine. So that even means there's more pressure in the system that you have to be able to manage. So I really, roundabout way to answer your first question is I really look at it as how do I take advantage of things that I think are mispriced and relative to the things around them and relative to the opportunity set. We have two engines that drive our portfolios. One is a relative value market maker framework. We're in static space, not predictively, looking at the world and saying, how does everything in a 10-dimensional matrix relate to one another, and what's out of place? That's one. And then two, the second one is predictively taking that forward and looking at it into the future and saying, relative to the distribution of potential outcomes going forward, what's mispriced? What should be here and is here? And how does that look going forward? So again, trying to find out relative to everything else and relative to the predictive outcomes, where is there an opportunity? It's not necessarily just buying an asset and saying, is this cheap? Is this expensive? And playing in two dimensions. It's a very different kind of approach.
Okay, so I think we'll certainly get into that and try to tease some of that out more. But maybe before we do, let me start or ask one other kind of broad, high level question here, and that's about your view of just when you think of your future and retirement, what you might do in retirement, what you might not do, where you want to be when you retire, what you want to be. How do you think of that?
Yeah. So for me, and this is going to sound almost cliche, but work is an extension of self, right? Work is not a thing that you do so that you can do the rest of your life. I'm fortunate to have my work be an extension of what I love. That's kind of naturally kind of happened as I've moved. Through this process. This business is a platform for my dreams and aspirations, and I tell the guys that work here and the girls that work here, it should be a dream, a platform for theirs as well. It sounds super cliche, I know, but it's true. We try and affect positive change and educate with this platform. We try and create things that we think are cool. It can also do those things. And ideally, this is there's a reason it's named Kai Volatility. That's my son's name, right? Ideally, this is a platform for them as they grow as well. It is not about, for me, making money at this point. Fortunately, I've been, put in a position where it's no longer about sustenance. Right? It's about dreams and aspirations, and I'm fortunate to be able to do that. But those are my goals. My goals are not to go sit on a beach and wither away. Life is short, and I'm fortunate to have a platform.
So you're not the guy that's going to get the 5-iron out and head to the course.
No,
call it a day.
Again, everybody has their things, and there's nothing wrong with that, right? And there's a place for that too. It's important. In my mind, balance is everything. You need to try and do some of that too, so you can do the bigger picture stuff as well.
You may have answered this a little bit already, but the first thing I thought about when thinking about your personal portfolio is this idea of time frame. So, all of us, I think, are trying to achieve the best long-term outcomes with our portfolio we can. But you have your work around dealer flow, which is sort of, I think the signals at least are shorter term in nature. Then you have your macro views, which I think are a little intermediate or longer term in nature. And then a lot of people, and I don't know if you do, a lot of people have sort of a buy and hold portion of their portfolio where they just put things away and they hold them for the long term. How do you think about balancing all that? Or do you even have all of that in your portfolio?
Yes. Time is such a huge component of how I think about the world and how our products operate. Back up a second and say, one way that we're unique, and I kind of mentioned this beginning, is that we look at the world in not just two dimensions, up and down. We really try and think about the distribution of outcomes. And distributions are not just static time. You're dealing with that out into time. And that's kind of comes from my world of optionality, but it's also a very philosophical kind of approach. And so time is a critical component to prediction. And it's not just a component because of compounding and the value of net present value of cash flows. It's powerful because different things operate with different lags and have affect prediction on different timelines. So to your point, we very much think about secular kind of trends and put those in on their own kind of timeline, right? And lay them over with faster acting other effects, some which operate on minutes and hours, right? Market microstructure is the world in which everything works, and positioning affects within that market microstructure. But underneath it, there are bigger trends. And as you mentioned, some of them are just compounding, right? And the value of money. And to your point, like certain things you want to own, things that make money over the long run. So there's a value to that. That's very slow. And there are, as over any time period, less than a decade, fundamental values are they are a 0% prediction to outcomes. So even on a yearly basis or a multi-year basis, they do not provide a framework for how to invest. That said, we live longer than 10 years. We live generally on average about 80 years, and there is a value to looking at decade plus outcomes and fundamentals. But that does not play a huge role in my in my investment theses. For the most part, I'm looking at prediction and what's likely to happen. We are currently in a period that is very different than the last 40 years, in my opinion. We can get into that a little bit. And that is a secular thesis, which is 10 to 14 year thesis. And that very much affects our general approach. That said, within that context, that's a long period. there are going to be years and multi-year periods that operate based on kind of medium-term flows and realities that are cyclical flows within that secular kind of framework, and then even then reducing to monthly, quarterly, monthly, weekly, we have more positioning and short-term flows perspective. All of these are overlaid when we're making our investment decisions across the portfolios.
I'm wondering, without talking about specifics, I'm just wondering, like on a percentage basis, if you think about sort of the dealer flow and the shorter term stuff, and then you think about your views on macro over the intermediate term, and then you think about this stuff that you might put away and buy and hold. I mean, as on a percentage basis, how do those sort of work into your portfolio?
It depends on the time period.
Okay.
If we were sitting here in 1985, 1990, assuming what I know now, which obviously I was a young lad at that time, I would be much more aggressive with beta, right? Just broadly, I would have had a different secular view based on my framework of how the world works. It would have been a much more monetary policy driven regime with that was very favorable to capital and to equities and to bonds. And the 60-40 thing made a lot of sense for 40 years. That does not make sense in this regime. It does not work in this type of what we believe is a rising interest rate environment. And we can get into that whole thesis, but so that changes. Right now, my long-term beta of the portfolio is 0 because I believe the expected value in the next decade for equity returns as a broad market, it doesn't mean I don't have stocks in the portfolio, is 0. And in real terms, I think it's considerably negative. I also think long duration bonds are also negative expectancy in real terms for the next decade. So I think 60-40 is not only dead, I think it's a problem for the portfolio in the short term. That said, that does not mean you do not buy short duration bonds and manage your cash, because if you leave your money in cash, that's also a significant negative percent return. So question is how much of that do you put in your portfolio and how to use it? And we can get in under the hood on that, but that is not the core thesis for how I operate during this cycle. Now, I have had a ton, and I still have some residual private equity, venture capital, a lot of real estate in the portfolio that has beta, right? I also have exposure to areas that I think will do well in this rising rate environment, which we can get into. But I offset the beta and the market exposure on that internally because I don't believe in the broad market beta that will exist during this period.
You had sold your market making business a while back and come into some money. And talking to people who've done that, like they tend to go two different directions. Some people say, all right, I've come into a bunch of money. I'm going to de-risk my portfolio. My biggest goal here is I don't want to lose this money. Other people say, I'm really building this money for decades. I don't care if I lose 50%. I want to invest this money aggressively. And I'm just wondering, did your thought process change at all when you sold your company?
So my thought process changed, but not for the reasons that you laid out. As I mentioned before, I started as a market maker. So I was naturally more predisposed to less beta, right? That's just kind of because I looked at the world in relative value terms and looked for an edge. So it took me a while because I sold the business in 2010 and really started investing more aggressively as an asset manager in a very different way in 2011. And so at that time, there was a place for beta in the portfolio. And again, I layered in a lot of venture capital, private equity, real estate, as well as some public equities. But it took me a while to get comfortable with that, right? I wish I did more in retrospect, right? Because during that period, it would have, a wonderful decade of, for beta, and broad, market exposure. So I really came into even though, I'm a healthy 46 now, I really didn't, come into long kind of asset investment in a meaningful way till 35. And again, it was really a de facto thing that happened because I had a liquidity event and I had to put more scalable assets to work, and not in there weren't enough non-correlated products or, after at that point. And again, glad I did. They were paid off, and I've learned the value of that broadly. But I also have been thinking a lot more macro and very differently about how I invest as a result. So I've learned a lot through this process. But I really had two kind of chapters of my life investing. One was really as a market maker, as how I came into the business, and then later really as an asset manager de facto for myself and eventually for clients. And the two have really kind of merged this top-down macro analysis with this bottoms-up kind of market structure piece over time.
You mentioned the 60/40 portfolio, and your outlook for it is not that great, I think, to say the least, going forward. A lot of people who listen to this, we want people to learn from how you build your portfolio. And a lot of people will probably be sitting in something that looks similar to the 60/40 portfolio right now. And I'm just wondering if you could talk a little bit more about why you think the outlook for that is not great going forward if we look into the next decade.
Yeah, absolutely. So let's start first with why everybody's in it. If you look at a graph from 1981, 82, all the way till 2020, it is a straight line, diagonally down, top left, bottom right in interest rates, right? If you look at a chart of bonds. There's a couple spikes along the way, but you can draw a straight diagonal line down to zero. That is the Federal Reserve gaining dominance and controlling every downturn there is in an economy by providing more liquidity into the system. In a monetary policy driven system, long duration bonds, obviously, if yields are going down, do incredibly well, right? And by extension, equities also do very well. Why do equities do very well? Well, one, more liquidity is being created and pushed into the system. And specifically, not being pushed into the system. People think all stimulus is the same. It's very important to distinguish. Monetary policy drives to investment. 95% of the money that by lower interest rates, the money that's borrowed goes to corporations and wealthy individuals. Right? It goes to investment. And those people take that money and invest it. If it's not corporations themselves, it's the people with the money putting that money to work. That drives better equity returns and higher multiples. It also, the more money you give corporations, it allows growth to outperform value. It allows duration to do very well, and drives multiple expansion, and other trends that we could go on and on about. But we have seen a massive multiple expansionary period, margin expansion as well. We're at record margins still as a result of loose monetary policy. These are trends that have not just happened recently, but we've seen in any other supply side situation. Monetary policy is supply side economics. It is sending money to capital, sending money to supply. Okay. What happens when that reverses? Okay. And in theory, you could do this forever. Let's stop here for a second and say, why is it reversing? In theory, you would do this forever. It's great for stocks. It's good for bonds. It leads to expansionary, why can't the Fed just keep printing more money and sending it to capital? Well, America has the ability to keep borrowing. It has the strength of the dollar, et cetera, right? It's what's led to all these calls for modern monetary theory, et cetera. The problem is not that. It's not the borrowing. That's what people think is ultimately kind of the restrictive piece. It is actually the fact that you keep sending money to capital for 40 years and it leads to massive inequality. The Fed has two mandates, which is price stability and maximum employment. But it does not have a mandate at all for who gets the money, right? They're maximizing GDP. And that's what they've done for 40 years. The problem is they haven't been in charge of the distribution. That's government's problem. And the distribution measured by Gini coefficients got way too wide. Got to a point where people who are the younger generation in particular, not just, we think of stratification as top versus bottom. The bottom was actually the younger class. They were the labor and they didn't have the benefits of having investments. And they have not participated on the GDP expansion. Ultimately, those people have now grown to political dominance and are saying the system is unfair. It doesn't work for them. They can't afford houses. Assets have gotten too expensive. They're not making enough to keep up. They're living at home. They're trying to create households. They're at 40% of the household formation. Millennials are at 40% of the household formation that baby boomers were at their age. They're at 40 to 50% of the wealth creation that baby boomers were in their generation. So it is a political issue. It happens again and again. This is why we're in this 40-year kind of general cycle that we see, 2 generations. And here we go. We're heading back into a populist environment, which has been very clear. The right has been pulled right and the left has been pulled left. When that happens, monetary policy has to compete with fiscal policy. We've seen $8 trillion of fiscal policy in the last couple of years. That is a record in real terms. It is the size of the New Deal. It is in GDP adjusted, it's actually many times the size of the GDP in real terms, but in terms of the size to the economy, it's the same size. As bigger than the next biggest real one, which was the Obama stimulus, by 8 times. Okay, 8 times the size of the Obama stimulus from the Great Financial Crisis. So that money is inflationary. You send money to the bottom part of the distribution. You start trying to control that. Interest rates trend higher. 68 to 82 is the last data we have of an inflationary period driven by populism. What happened to equity markets 68 to 82 when interest rates went higher? That's the last data set we have. They went nowhere in nominal terms, and they lost 70% of their value in real terms. The GDP during that time, to be clear, was above trend. The economy was very strong during that time. Stronger than it's been recently, counterintuitive. But the equity market did very poorly, and you better believe long duration bonds got crushed because interest rates went to 20%. So if history is a guide and you understand history and you understand the importance of money supply, right, in the system, you will understand that equity markets do very poorly. This is not about the economy. Equity markets do very poorly in rising interest rate environments. And guess what? Bonds also do very poorly, obviously, during rising interest rate environments. So that's the broad thesis. I could go on and on about it. I'll stop there. But these are big macro cycles. If you believe that populism is here to stay and that the younger generation is going to continue for some time to try and rebalance what has become a record inequality issue here domestically and internationally, then equity market multiples are in for major problems. It doesn't mean the economy is going to do awful. You tend to have more recessions during those periods, but actually the economy tends to grow above trend in real terms. So counterintuitive, the market is not the economy. What you've been taught for the last 40 years is that you just keep buying the dips and over the long run, you'll do very well. And if you have any risk, you offset it with bonds. That's because that's what's worked for 40 years. And everybody that manages money, whether they've been ever educated in markets in any real way or not, has just been taught this very simple rule. And it does not work that way.
I'm wondering, and I know you're more active in your approach, but a lot of our listeners will be, people who have 401ks who are sitting in these 60-40 type allocations. I mean, how would they think through like what to do in an environment like this? If they're not using active strategies, I mean, how would they think through like how to update their portfolio for this type of world?
So passive investment, which is, obviously look at the size of Vanguard, right? Passive investment has become incredibly dominant, not because it's a new technology, not because it's this new idea that, nobody ever thought of. It started 40 years ago, 35 years ago, because it started to work. It didn't work for 20 years. And that's why nobody ever did it, right? During this, what did you do 68 to 82 as an investor? What did people do? Do you think people just went and bought, did 60-40? 60-40 didn't exist because it didn't work. So this is an artifact of recent history, and what's worked in a Fed-driven, monetary policy-driven system. And so the answer is you have to find an edge. That seems crazy to people. An edge, like what's an edge? The edge doesn't exist. These are efficient markets. How you want me to invest all my money in something with an edge? How do I find an edge? It's hard. If you were going to defend yourself if you had a legal issue, you wouldn't defend yourself in court. You'd hire a lawyer. If you had a medical problem, you would go, hire a doctor to solve your problem. But everybody thinks they're a money manager. Everybody thinks they can invest. Everybody has their own self-directed IRAs and everything else. It's hard. Having an edge is hard. It's expensive. If you look back, my team is full of PhDs and quants, and it takes a lot to create an edge. And that, unfortunately, is not what passive investing is about. Passive investing is about, hey, just buy the dip, keep buying, close your eyes when it dips more. And ultimately, over the long run, you will succeed. Keep your costs down, keep your expense ratios down. And again, that worked in the last environment. My view is that won't. So it's hard is the answer. I hate to tell you that. You have to find money managers with an edge. That can be different edges. That can be fundamental edge. Again, we talked about over the long run, it doesn't matter. Investing in the economy could do very well. Macro funds are likely to do quite well if somebody's got an edge. Convert arbitrage, vol arbitrage, merger arbitrage. There's a lot of places to make money. There are a lot of businesses to make money in, but that does not mean that you should just buy and hold the market for the next 10 to 15 years.
Yeah, it's interesting because, active managers have obviously been destroyed, in the press over these years. And, the question is how much of their underperformance and how much of they did poorly was the fact that there were these tailwinds to passive strategies and how much of it is active is really, really hard. I don't know the answer to that, but you could definitely argue in the period going forward. I'm obviously talking my own book because I am an active manager to some degree, but you could definitely argue active management is going to be more important here going forward than it has been, in the past few decades.
Unequivocally. And not just that, it's not just because beta is less likely to work. We are on a turn. And when you're on a turn, there's more opportunity for active management, right? There's also an active management can mean a lot of things, right? It can be finding a fundamental edge. It can be about flows, understanding supply and demand. We can go on and on about what that edge is. But yes, the edge becomes more valuable during this time relatively, but there's more opportunities. There's also more opportunities because risk premium increases, liquidity decreases. There's less ability to borrow money to create, to provide liquidity, which can create more relative value opportunities. So this should be a very good decade for all kind of people with edge because the opportunity set should increase, but also because relative to equities and beta, there's likely to be a greater opportunity.
I just want to briefly ask you about bonds. It doesn't sound like from what you said earlier, you have anything other than short-term bonds maybe in your portfolio at this point. But I'm wondering, when you have had bonds throughout your career, how do you think about bonds in your portfolio? Does your macro thesis at any given time, does that drive sort of what your exposure to bonds are and what bonds you hold?
Absolutely. So this is an interesting question. I'm going to kind of take outside the box a little bit. Yes, to your point, I do not have duration exposure in my portfolio, but luckily the yield curve is inverted. So that doesn't really, that's probably a good thing even in the short term in terms of the yield I'm getting as well. When you are managing, so we're fortunate in the 60s and 70s, there were no real things called CTAs, right? There was no ability to, and derivatives, there was no real way to express exposure without owning the asset itself. Stocks and bonds are very capital intensive. When I want to buy a stock, I got to put all my money, $1 million a stock, I got to put $1 million into it. If I want to buy a bond, I got to put $1 million right into buying that bond. The beauty of what we do and what a lot of other CTAs and entities do is when I get an investment, I'm expressing an exposure without buying the asset. I'm posting margin to have a certain exposure. And this is, again, it's a bit complicated outside the box for probably your average investor, but something they're going to learn more and more about. And I'd love for them to think about is you can get exposure to stocks, you can get exposure to bonds, you can get exposure to commodities, whatever you want really in this world without actually putting down all of the assets. When interest rates were zero, right, it didn't matter. But now that you can get 5% under the hood, if I can go buy a bond and a short duration bond and get 5% and then post that bond for collateral to get that exposure to whether it's duration in bonds or whether it's stocks or whether it's commodities, you're getting your return stacking, your yield stacking, right? You're able to get the bond exposure while still getting whatever other exposure you want. And that is something that is fairly foreign to most investors, but incredibly powerful in this yield rising investment, not only because you're stacking those returns, but also if you do it at short duration, gives you an embedded inflationary hedge. Your returns are more real returns as opposed to nominal returns, which again, in a rising yield environment is very important. So the way we buy bonds, we don't just take a part of our portfolio and buy bonds, and definitely not long duration bonds because I don't want that exposure. But I am getting under the hood of almost, 70% of my portfolio. I'm getting 5% yield before the second I walk in the door. So I think that's an important thing. And you don't have to choose between bonds or exposure, which is what most people are taught. You can actually do bonds underneath the hood and get exposure at the same time.
And what's great is, obviously for high net worth investors, they have access to people like you. But for your average investor too, you're seeing a lot of stuff happening in the ETF space now that's giving people access to these types of strategies that they really never have had access to. I'm sure there's a danger that comes with that because you have to understand what you're investing in, but there's also an opportunity for people who do know what they're investing in.
Absolutely. And I think that's the one risk you have to, as we talked about with active management, the risk is it a good manager, right? Does this person have a real edge, or are they just trying to package something that's hot under a hood? And, if it's just a structured product, it's generally not going to have a real edge. It might play a role in a portfolio, but you kind of get what you pay for.
And I'm sure with individual equities, I'm sure you take a very similar approach here in terms of using leverage. But do you also buy individual stocks? I mean, we obviously won't ask you which ones you buy, but do you express some of your views by buying individual stocks at different times?
I do. And to be clear, just because I don't have beta doesn't mean I don't have opinions on different parts of the equity market, right? That's part of the idea. That's one edge in active management. My broad view for equities going forward here, and this is what we've seen in the past, this is informed by history, and what I believe the political winds are likely to drive as well, is during times of populism, money flows through government. It doesn't tend to flow through capital markets as much. This is what demand side economics is about. People want to rebalance the distribution. And so when that happens, it's a demand side driven approach. So you want to look at who is going to get more consumer demand, right? You got to look at where the money's flowing to from government and look at stocks that will do well under that environment. So broadly, you want to sit next to the fountain of money in the next decade, which is government. So go look at the balance sheet of the government, right? Go look at the what they spend money on. What does the government spend money on? Infrastructure, healthcare, right? Energy policy, defense, right? Like we can keep going. Just go look through the line items. That's where you're likely to see money coming into the system and where people or companies are likely to perform better. That's one major trend. Two, I would focus on the fact that if you're in an inflationary environment, it tends to be a time of protectionism. It tends to be a time of deglobalization. Why? Because populism is local. People in a country want resources for themselves. Corporations are international, right? They drive globalization, technological advancement, expansion across countries. That's what we've seen in the last 40-year period. Massive push in globalization. Not a coincidence that China went from an agrarian society in the 70s to almost the biggest economy in the world after us, right? So it's those trends tend to reverse during times of populism. That leads to more global conflict from 68 to 82. We had the Vietnam War, which was a hot war. You had the beginning of the Cold War, right? Weird. We're getting a hot war in Russia, Ukraine, where we're getting more and more involved, and we're getting a Cold War with the next biggest economy and military power, China. Those trends are likely to continue as well. That's a trend you can take advantage of. Defense should be a continued place of focus, but also onshoring of things globally, right? And looking at local demand for where you're focused should be a focus as well. Populism also drives people want certain things. People talk about how real estate is such a bad shape and you got to get out of real estate. Listen, commercial real estate, I would agree with you. There are major problems for commercial real estate. That's more connected to the supply side. I think we're going to see a massive disconnect between commercial and residential, particularly starter homes. There is a massive demand from, again, household formation is the 40th percentile from people, millennials on down, looking for to start. And they're getting more and more money and are able to make these down payments to the extent they can. Things are expensive there and people are worried. They're going to continue to get support from government so that they can continue to drive demand in the economy. Places like real estate, and particularly, domestic starter homes, interesting kind of place as well in a portfolio. So you want to take advantage of these broad trends, right? This is where is the money coming from? Who is it flowing to? What is that likely to do in the economy, and those are places to focus. That said, that does not mean that money is flowing to investment on the top end of the spectrum. Things that have done incredibly well in the last 40 years, art, right? Things that have done wine, private jets. Guess what? That's not going to do so well in the next 40 years. So that's kind of the broad framework to think about. So relative value, there are some significant opportunities. Growth versus value has been a 40-year trend. I expect that to reverse. The fundamentals will matter again. Sounds crazy, but fundamentals will matter again when it becomes a put on a business. Ultimately, companies will have to generate their own cash flows to generate future returns, which has not been the case for 40 years. That is another major thing to focus on.
Well, now I can tell people I'm not buying a private jet because my outlook for the future of private jet returns is very low. That may not be accurate, but I can at least tell them that. I'm wondering, and I probably already know the answer to this, but do you care at all about market valuations in what you do? Like if the market gets incredibly expensive or gets incredibly cheap, does that ever affect your investment process at all?
So I've given this analogy before, so people who listen to my stuff this might be a repeater, but I think it's important. I think of valuations as, imagine you're on a jet airplane, right? The trajectory of where that plane is going is the price of stocks, right? Of markets. The fuel in that airplane is liquidity. It's the amount of demand there is for markets. The elevation, how high that plane is off the ground, is valuation. Okay. At the end of the day, where that, you don't care if you're at 5,000 feet, 10,000 feet, 20,000, 30,000 feet. If you got a lot of jet fuel in that engine, it's going to keep going up, right? But when the liquidity comes out, right, when there's less, all of a sudden the spigot stops. All that matters is how high off the ground you are, right? Are you going to be able to glide down and make a safe landing? Because if you don't have enough fuel on board, you got a problem. And I think it's not a great metaphor, but the idea here is that valuations are a risk management tool. They are a put on a business. At the end of the day, whether a stock goes bankrupt or not during a time of illiquidity is dependent on whether or not they can provide liquidity for their business themselves. The Teslas of the world and the Ubers and all of the growth names didn't have to make money for 20, 30, 40 years. Even Amazon wouldn't probably have existed if this was not an expansionary time of monetary policy, in my opinion. Great ideas. They eventually get to scale and if given enough time, will succeed, but they need cash flows in order to make those realities work. And liquidity provides that in terms of monetary policy, but times of rising interest rate take that away. So the answer to your question is, do fundamentals matter? Yes, but they are a put on the valuation of a stock and matter particularly during times of illiquidity. So fundamentals have not mattered for 40 years, for the most part, particularly the last 20, 25 years. They will matter as we go deeper and deeper into this next cycle and interest rates increase.
And as we carry that from individual stocks up to the market overall, I mean, do you think that matters at all? In terms of how people allocate their money, does the overall market valuation matter?
Yes, of course it does. But again, as a put on the market, let me go back to 68 to 82, which again is just we keep going back there because that's the last time we saw this increase in interest rates, which I believe is happening. 68 to 82. At the beginning of that cycle, broad market multiples, price to earnings ratios, were 20 to 25, depending on where you kind of start, right? At the end of it, it was at its low 4. Okay. I mean, that is a 80 to 85% reduction in the value of the whole market. That seems like, how can the whole market just change by 85% at any moment? People are sitting here and say, oh, well, this should be, and to be clear, that's just the tip of the iceberg. Price to sales is a dramatic difference because margin contraction during that period was dramatic. We're at record margins again. Guess what? You're likely to see massive margin compression as interest rates go up and the cost of money goes up. The cost of labor goes up, right? The cost of all these inputs to business are going up. Deglobalization is going to drive, again, another bit of margin compression. So price to sales now is, price to earnings, you're like, it's kind of expensive. Price to sales is off the charts. You better believe you're going to get massive contraction in that as money comes out of the system. So The answer is no, not as a trading mechanism. Right now, multiple contraction is likely to come into the system, but at some point on a stock by stock level, it becomes a put on not just every stock, but eventually the whole market. And so it starts with a stock, but it eventually goes through to the whole market.
Just one more for me before I hand it back to Justin. I'm just curious your thoughts on international exposure. You have kind of the Jack Bogle view of the world, which is, you've got everything you need here in the US. You don't really ever need international exposure. And then you've got people who look at, more advanced metrics who say, you get that diversification benefit. And I'm just wondering, what do you think about the need for US investors to have international exposure?
So we're sitting at an interesting time for international exposure. Obviously, valuation wise, right, there's a massive disconnect between the world and the US right now. And that's been driven by quite some time of this, them moving away from each other. But that said, there's a fundamental reason for that. And that's because the US has the power of the exorbitant privilege of the US dollar. And you can argue, I think with good credence, that during periods of resource scarcity, during periods of deglobalization, that power, right, is ultimately becomes more important. The value of some fundamental value to things is more relevant, both militarily, economically, in terms of commodities and resources, all of those things. We're already seeing it happening, right, in the last year and a half. That trend is likely to continue. And the exorbitant privilege of the US dollar allows us to export inflation. It allows us to continue to print money locally while people still are looking for, supporting our own currency. That eventually will export inflation abroad and cause more problems abroad. We also see during these periods more volatility and dollar-denominated debt crises, right? And eventually, some major problems because ultimately these other countries don't have that exorbitant privilege. So I would argue that the macro environment is not very good for being off the big ship, right? You're often kind of bumpy waters without the safety of the US dollar. Now, people may come here and argue, and I think it's a valid argument, that maybe the US dollar is facing headwinds itself, and maybe that will come into question. And if that's the case, then yes, valuations are very wide, and there would be some type of repricing that goes on there. That said, as a broad trend, I would be very, very hesitant, especially at this turn, to be wading in turbulent waters on a small ship. So I think those are the things you need to think about. I don't have one answer for you there, but as a broad trend, I think U.S. developed markets are places of safety during an otherwise rebalancing market, benefiting from the resource scarcity both of money and commodities and defense, etc. But again, there's always a potential break there, which I would be watchful.
You explained at the outset that you have, part of your mentality is a trader mindset, and part of it is these macro views, which I find very interesting, actually, as we've talked here. But I'm curious, what would you say, because this will help me understand a little bit more about how you're personally allocated. What would you say the max drawdown on your portfolio might be if you were to try to put a number on it? Would you think?
On my whole, net worth?
Yeah. Well, on what you have that you're actively managing, not like real estate stuff or holdings outside of liquid assets, I guess.
Okay. So to be clear, my funds, which I have, I can't say publicly, but I have a decent size of my net worth in, have a beta of 0. Right. And each one of them, not two of them do. Sorry, 3 of the 4 do. One of them is a long vol fund, which has a negative beta to it. Those products have other exposure, but it's very non-correlated. And particularly if you're diversified across all 3, which are quite different strategies, we have a very non-correlated, and again, not just non-correlated beta to stocks, but non-correlated to bonds, non-correlated to commodities, non-correlated to pretty much every hedge fund index you can drive through it. So over the long run, I would say, I would expect, meaning on a yearly basis, worst kind of outcomes are across the three strategies is somewhere in the 10% range. So quite low. Our historic Sharp and our multi-strat, which invests across the three, has been, again, I can't give specific numbers, but quite strong, right? So on a risk-adjusted basis, looks much better than equity markets. It's funny, equity markets, nobody really talks about this, but the Sharp equity markets over the long run, right? Never mind the Sortino, way worse, is like 0.16. It's awful. On a risk-adjusted basis, nobody, for some reason, looks at the risk in equity markets. They just look at beta, right? If you looked at risk-adjusted returns, it's absolutely horrific. If I told you I came to you with an investment that said every 10 years, on average, your investment's going to draw down 50 to 60%, right? But you're going to return kind of 7.5% per year, you would run for the exits. You would never even consider it. But that's what people do for 60% plus of their portfolio. So yeah, I guess my answer is relatively low compared to kind of a stock portfolio.
Yeah, but I think that's important because the way you've set it up is no matter really what happens in the stock market, in the bond market, strategies like yours, and there are other, people have to find them, you have to dig around, but you have to find those uncorrelated things that can be incorporated into a portfolio that makes sense, because those are the things that when shit hits the fan, are gonna save you probably.
Yeah. I mean, again, I would argue, we're starting from this bias that you have to have long equity exposure in your portfolio. I don't know that if your expectancy for the next 10 years in real terms, and I want to be clear, not enough people think real because it hasn't mattered. Again, it's bias. Like, trust me, everybody was thinking about real returns in the 60s and 70s, right? Nobody's even talking about real returns, anymore. But in real terms, the expectancy is quite poor for the next decade for equity markets. I think most people who do any analysis would agree with that. That's not like a controversial topic, really. The reality is that we just look at the last 40 years and say, well, that it works, so we got to keep doing it. It's not necessarily a rational perspective. And so, yes, you need non-correlated in that environment. I think that follows, right? And that's hard. And I think that's part of why people don't move off it as well, because it's hard and nobody knows what to do.
Let me just go back to inflation for a second. So it seems to me, and tell me if you agree or disagree with this, that the market is trying to figure out like where the Fed is on their rate rising cycle. And sort of, I think you have some people making the argument that, the Fed's going to have to start lowering rates maybe end of this year, or at least going into next year when we go into, potential slowdown. But, based on, I think what you're saying, I'm not sure you would agree with that. So what's the hole in that thesis, would you say?
You did a great job early on, starting with the very most important question is time, and cyclical versus secular, right? It's all about time. All that mattered for 40-ish years was the cyclical. Why did only cyclical matter? Because the Fed had control of the system, and if the Fed could lower interest rates into any type of cyclical downturn and re-stimulate to make it cyclically positive again. In a system where the Fed has complete control, it's a two-dimensional system. All that matters is liquidity, and that can be tracked by just looking at the Fed balance sheet and looking at it across kind of how equity market and asset market returns have been. All that has mattered is, what is the Fed doing? The problem with that now is the Fed is losing control of that system. It is not just them in that box. There is fiscal policy. There is government trying to address the distribution, right? And sending money into the system. Fiscal policy has a velocity of 1. What does that mean? That means that money, when sent to people, gets pushed directly into the economy. Monetary policy has essentially a velocity of 0. I've used this analogy again. It's a favorite. People will laugh because I say it all the time. We've been sending money to planet Palo Alto. We've been sending money to this other planet that creates goods The money, if we print $20 trillion and send it to Planet Palo Alto, that money doesn't go into demand. That money creates Ubers and Teslas and Amazons and Ubers and all these wonderful, futuristic things. And then that supply gets beamed back to our planet. The money never hits our shores. The supply does. And that's deflationary. And that's something that people haven't understood for a long, long time. You can print $50 trillion and put it in a safe, and that's not inflationary. You can send it to another planet, that's not inflationary. And if they send back supply, that's deflationary. And so we've been in a very deflationary environment, and so the Fed has been able to push against that secular trend with cyclical money supply to affect short-term cyclical effects. That system is a two-dimensional system with one party in control. It's a very stable, low-risk, high-reward situation. The problem is now the Fed has to battle against inflation, and there are two mandates. One of them is price stability. Now those two different mandates are in conflict, and they cannot battle against inflation and control employment with the same direction. That creates a much bigger problem. It is a system with less control, a much more leptocurtic outcome after a very long period, and that is both dangerous broadly to markets and is likely to cause bigger picture problems on a more secular basis in terms of demand.
When you think about the broader assets, the ones that a lot of investors have, can get exposure to, I'm thinking gold, real estate, energy, commodity, how do those, for you, how would you recommend an investor? Like I'm thinking myself, I have my SEP IRA and so, thinking about those sort of more real type assets, those being incorporated into someone's portfolio, what's your view on, I'm guessing that you would support that.
Yes. Hard assets, things that you can drop on your feet have a fundamental value, much like cash flows of a corporation have value. I want to be clear. I'm not saying don't own assets. There's two ways to think about this. The easier way for people to think about the first order effect is inflationary. Inflation makes fundamental things, they keep their value relative to money supply, right? So naturally inflation should be good in nominal terms for things with fundamental value. That's the easy step. The problem is there's a second order effect. There are several second order effects that overwhelm that first order effect. Contractionary Fed policy removes money from investment broadly. That's true for equity markets. That's true for bond markets. That's true for commodities. That's true for real estate. That's true for all of them. Okay. So that's a negative for these at the same time. For equities and risk assets, it has a second negative effect in that if yields go higher, there's no longer not only not a TINA effect, there is a reverse TINA effect. Money is flushing out, right, to the bond market. There's an alternative. So money flows out of risk assets. So you want to be in the least risky, least kind of the stretch kind of risk assets and into kind of the safer places there. You get margin compression across stocks and entities because the cost of inputs goes up, as we've discussed. And then you have a higher discount rate to these things as well. So the question is not really, hey, what hard assets do you buy? You want to buy hard assets because of that first order effect. But you really want to be thoughtful of these second order effects as well, which are very, very important, and actually in many ways more important. And I guess lastly, risk premium increases. So any place, there's less liquidity in the markets. So anything that's volatile, illiquid is dangerous during this time because liquidity is coming out of the system as well. So the best places to sit are places that are relatively liquid, that have real value, and that ultimately will produce hard cash flows underneath them. I like real estate on the low end, meaning low end and starter homes, as I've mentioned. I think that has a real place to benefit from economic growth and government support for what are otherwise considered essential kind of things for the populace. I like industrial commodities because I think we'll actually have a pretty strong demand cycle despite what's going on in China and the deglobalization. I do think we'll still have particularly good local demand for industrial commodities. There is a gap, for example, in natural gas here and in Europe. guess what? We're going to onshore, going to take advantage of that. Something like that is an interesting place to play, particularly on that spread. There are things like this that you can take advantage of. And yes, your general goals are going to be what has real value, what has real cash flows, what has real fundamental kind of book value. Gold and precious metals, I think, are also interesting, although I think you have to think about them not two-dimensionally, like up or down, right? And really think about the distribution of some of these assets as well, which is something also in our kind of wheelhouse, right? Gold and similar to FX, similar to, which in my opinion is not like industrial commodities, similar to FX, similar to bonds, is likely to be very volatile in the next 5 to 10 years. 68 to 82, again, very volatile time for gold, but gold did very well over that period. So you have to think about how you invest in it. It's a liquid, so it has some problems there, but it is, I think, a positive first order effect with significant increasing volatility. So I like to play that with calls or opportunistically when the volatility is in your favor. Something like industrial commodities, again, I think it has more of a put on it. What we've seen is this last period was a time of the Fed control. Very controlled. If you played the Fed put, you did very well, right? As we've seen in the last week, and again, many times in the last year, commodities and industrial commodities are likely to have a put on them because it is a time of resource scarcity, and entities with that resource will flex those muscles, whether it's the US with the SPR or it's OPEC with kind of putting a floor onto prices. It is a time of conflict. It is a time of resource scarcity. So industrial commodities I see as less volatile, which is again what we saw 68 to 82, but more of a positive trend. So point is, yes, commodities are a broad trend to take advantage of, but how you take advantage of each one, what their personalities are like, how you play them is going to be different, commodity to commodity, hard asset to hard asset, stock to stock.
And I just want to say one thing before I hand it back to Jack here. I think that what this conversation has sort of helped me with, and hopefully our listeners with, is you have, this broad sort of fundamental view as to what's changing. And I think things like the rise in populism, I didn't even really think about how in 2008, 2009, like a 18 or 19-year-old then, who's now a 30-year-old, who's still, they went through the financial crisis and they're maybe still living at their parents' house. Eventually, that demographic group is going to influence the political sphere dramatically. And then, following where the government spending is going to be, I think the deglobalization sort of theme. So thinking about these secular trends and how an investment portfolio can align to those things. These aren't like short-term macro calls where the market's going in the next 6 months. These are broader themes that, you've identified and vetted out and can articulate. And so I just think as investors sort of think about their own long-term investment strategy, this is a good exercise to try to come above the fold, come above, the WWE UFC merger news and, think about what's going to influence the markets over the next 5, 10, 15 years. So, I just wanted to make that comment because I think this is great.
Appreciate it, Justin. Yeah, the last thing I'll say here is if you got that secular trend right from 1982 to 2022 for 40 years, you are inordinately wealthy. There were a lot of big problems along the way. We had, tech bubble, we had the great financial crisis, we got so many things that happened along the way. And it doesn't mean you're not going to get drawdowns to that thesis, that you're going to have counter trend moves. But if you had conviction in that long-term, thesis that interest rates are going down and that equity multiples are going up and that growth is going to outperform value and all the things that I've talked about, you have made a tremendous amount of money. So getting that secular trend is the most important thing you can do. That said, that does not mean you're not going to get some big drawdown in that thesis, that things aren't going to move the other way, that it's not going to be painful along the way. You have to have that conviction and you got to be willing to look. And why do those counter trend moves happen? Generally because of positioning. Once a trend takes hold, everybody crowds into it because people see that as truth, right? And then it gets too crowded and you have to shake those longs. You have to shake that conviction. And that happened a bunch of times in that 40-year period. So to be clear, you can have a secular view of 10, 15, 20 years. Doesn't mean you're not going to get 30% drawdowns to that thesis or problems along the way. And so it's important to be active around that secular thesis. When positioning gets crowded, when things get overstretched, you reduce and you take things off the table. It's not just set it and forget it. The best outcome is getting the secular trend right and being able to play around it based on what's happening underneath the hood with positioning and market structure.
I want to go back to what you talked about earlier with private investing. You mentioned you've done some private and venture capital investing. I'm just wondering, how do you think about that sort of in the context of your portfolio?
Yeah, I mean, the reality is there was no better place to be than venture capital. We talked about growth versus value, particularly for the last 20, 30 years. If you had a good idea, right, you would have the cash flow to eventually fund it, and the valuations have followed. So that's been an incredible place of huge wealth creation in this market. Just go looking at San Francisco real estate. That'll tell you all you need to know, right? So that has been a place where I've been fortunate to have people that I know, and nothing better in what's an otherwise opaque world, right? To have people on the inside that are able to kind of vet out and help you see under the hood in real time, not just in investing, but also as you're moving forward. So I've done a decent amount of that, and that's been very good for me. That said, listen, growth is secular, right? Things will continue. Like good ideas will perform over the long run. The question is, do they have enough funding over the period that they need to survive and thrive? And so I think we're going to see a lot of money moving out of that. I think you're better off investing in big ships with cash flow that can then buy growth and provide the liquidity to continue to grow. So I think I would be broadly moving away from small cap. I would be broadly moving away from venture. I would be broadly moving towards cash flows and value. But that doesn't mean you ignore growth. So I do continue to find long-term secular trends that I believe in, but just make sure that they're underpinned by cash flows or at least long leeway before they need to refinance or raise money. So that's one. Real estate, as I mentioned, is a core holding. I think real estate is not a monolith. I think that word is very dangerous. Again, commercial real estate is a big problem, particularly right now. But that does not mean that if you're at the place where it matters, where the demand is and it's coming and we know it exists, that you're not going to invest there. So I like multifamily, I like single family on the low end. And particularly in areas that are popular to millennials and the younger generation. And then in terms of private equity, I think it's a great time to be invested in private equity if you have the right managers. Again, you got to pick the wheat from the chaff. You got to know where you are. You got to be careful of legacy holdings, and very thoughtful about who can generate, real edge. And I think there's a lot of private equity firms that are not a lot. There are many. There are some good private equity firms that can really provide value, right? They can take a set of portfolio companies, 100 of them, and then they can get knowledge and process that can ultimately really yield better outcomes for all 100. And that real value that they provide, I think, can be incredibly powerful. So I do tend to like private investment. I think they're going to get more and more opportunities as there's less liquidity. That may mean a re-rating to start with on some of the portfolios they have in companies they have in the portfolio. But I think over the long run, their cash flows underneath the hood will continue to improve. And I think that's important. Just invest in the economy, not in the market. Just remember that. And I think private equity is a good way to do that.
Just a couple more for me as we wrap up. One of the questions we always like to ask gets us this idea that not every investment you make should have a great financial return. And so I always like to use the example, I have a racing sailboat. And so I love to go out on Wednesday nights with my friends and have some beers and race around a race course. And it's a terrible investment, though. Obviously, boats are just money. You can just dump money into boats for the rest of your life. I'm just wondering if there's anything like that in your life where maybe you invest in it, but the return is purely not a monetary one.
Oh, yeah. I mean, everything, again, I try to think about everything holistically, right? Not just in terms of what is the cash that it's providing me, but what does that do for my personal ecosystem, that of my family, et cetera. There's definitely some venture capital and stuff that I do because, again, it provides me insight and interest in things that I think are good investments for the future. Not necessarily ESG, but things that that I believe in and that I think are important for where we're going as well. So I do a decent amount of investment in things that I believe in, not just that are going to economically, pay me out. Although that's always important as well, obviously. It has to be sustained in terms of it has to survive. So yes, do a lot of nonprofit stuff as well. And so it's not always about the profit. Now, I don't own a jet. I don't race boats or cars. I do really enjoy nature and things along those lines. So I definitely try and spend money there, and experiences, right? Both for me and my family is also something I like to spend money on.
A skier or a golfer or anything like that?
I was a skier before I had knee reconstruction. I am not a golfer. I did play a lot of sports growing up, and I really do enjoy sporting events as well. So my son and I spend a lot of, we had season tickets for the Bulls for a long time. We got Bears season tickets. We do a lot of that stuff and really enjoy sport.
Just one more for me before we wrap up. I wanted to ask you, I think as a podcast host, you get yourself in trouble if you have you on and don't at least ask for some breadcrumbs. So I'm just wondering, when you look at sort of the dealer positioning landscape right now, I'm wondering what insights you kind of have based on what you're seeing.
So, we were quite clear in late October, early November to expect a rally into kind of mid-December, late December to January. We're like, everybody was expecting Santa Claus and, January effect. And we said, no, expect a decline. So we got that. Just to kind of summarize, we said, buy the dip and run it to mid-February and then look for a pullback. We've gone play by play all of these. I'm not saying that to brag or to toot our horn, but this is just emphasizing how important positioning is in the short term, right? It's like, there's no other way to kind of see what we're, explain these type of calls other than, seeing who's too far on one side or the other. That said, sometimes that deal positioning is more opaque and less clear. And it's important to not just say, hey, I'm going to make try and call every turn, right? Those were more clear kind of things that we could be very, very outwardly spoken about. What I can tell you is the following. Back half of the year, really starting in mid-May, is a dangerous time for these markets. Why? We're talking about timelines, right? And different things that matter. There's a massive lag to monetary policy. You hear that all the time. But what does that mean? There's about $80 trillion to $90 trillion in global equities, about 40 to 45 here domestically. But global assets, long assets, is closer to 450 trillion. So really only 15 to 20% of total assets are equities, right? And all the other piece has a massive lag. What is that? Again, we've talked about it. Real estate, venture capital, private equity, commodities, it's all the other stuff. And that gets re-rated very slowly. Real estate's a big one, right? That is in the process of stepping down, particularly on the commercial side. Venture capital, private equity, again, just now getting re-rated. But even equities, call it that 80, 90 trillion, gets affected by buybacks. Buybacks in the first quarter were almost as big as all of last year, which are at record levels, despite interest rates going from 0 to 5. That tells you how slow that lag is. Next quarter, quarter 2, quarter 3, quarter 4 this year, it falls off a cliff. That is a direct effect on demand in equity markets. So if we're looking in the back half of the year, time, again, we talked about time at the beginning. This is an ongoing trend. You have to be careful because supply versus demand is becoming increasingly imbalanced into the back half of the year. It hasn't happened yet. Yep. People talk about how markets are forward-looking. Yes, markets are forward-looking, but you cannot divorce yourself from supply and demand. And if buybacks are happening in force, you got to wait until they don't. The problem is participants see this happening. And short interest is actually quite high. And you have a lot of people who are not exposed to that have to perform in a year, who are not exposed to beta. Anytime the market goes up, I get calls. I did great last year, but what do I do now? I'm underperforming the market. And it's not from mom and pop. It's from institutions. It's from entities that need to do well relative to the market. So there is a positioning situation now, moving more kind of shorter term, right? where positioning is quite short. And this is what actually tends to happen before declines happen, is markets get ahead of things. Things take longer than markets tend to expect because of reflexivity of positioning, among other things. And ultimately, those shorts need to be squeezed in a market, and they will get squeezed in a market until things happen. And it's aided by the fact that there's this lag in markets and things take a bit longer to push through as well. So currently, short interest is high. Buybacks are still hanging in. Things have not fallen apart yet. But positioning is getting kind of hurt in the short term. And this is a classic short squeeze that we've seen, right? This doesn't mean it's going to last only a little bit, right? It can continue to go on, right? There's other structural elements I can get into, which is the broad skew in markets and why over time passes. There's a general buyback that happens that also leads, and we've talked about this with bond and term flows, that tends to drive upward slope in markets no matter what. This risk premium decay leads to underlying demand that also pushes these things. But last thing I'll say, so we have current short interest, current counter trend, squeeze on positioning with a bad macro outlook. Okay, fine. Positioning versus macro. This is the game we've kind of been playing here for a little bit. But there's an important other distinction. The market is trying to call the Fed's bluff, and there's an inflationary underlying kind of problem as this is all happening in the short term. And if that continues, which we believe it will, that there will be outperformance. Again, this commodity issue the last week doesn't help. But if that continues to be the case, the Fed will have to continue to keep coming in and trying to stop the speculation in the market, try and dampen it down in the short term, and also get yields higher in the back end of the curve. You guys mentioned this, this ironically, right before this kind of bank run issue kind of came front and center, the Fed was actively trying to get, what was much higher yields at the time, the back end of the curve higher, and markets lower, and they got markets lower, but then the market came right back, screaming back, and now yields are dramatically lower in the back of the curve. This is not what the Fed wants. If anything, this is more stimulative to inflation, more stimulative to the economy, and a bigger problem. So the fundamentals, both in terms of fighting the Fed and in terms of the lag that's happening in the back half of the year, is very problematic to asset values. That is truth. But in this meantime, there's a lot of short interest and a lot of things that know that's coming and have to generally be squeezed. The situation tends to play out where markets try and squeeze, hurt, think you get some type of blow off top, right? And there's some type of squeeze before ultimately we get some downside tail. And that's our base case. We've been saying that for a while. The problem is the Fed keeps coming in and cutting that upside squeeze, right, as we go. And they're extending in a way kind of that squeeze that needs to happen and giving shorts kind of more power in that equation. So it could very well, because of that, last a bit longer before it resolves. Time itself can resolve this. At some point, people will give up on buying puts. They will give up on being short. They will give up, just based on time. And so I think that's another thing to think of. Eventually, the truth and the fundamental behind kind of what's happening in terms of liquidity situation and whatnot, and what the Fed wants will play out. We're in a process of shaking positioning as we currently speak. So I know that's not giving you month by month, week by week. I will leave you with one little crumb. Mid-May, the Monday to Wednesday of May OPEX, I don't have the dates right in front of me right now, which is about a month and a half from now, would be really when I think, given that we haven't had an unwinding and that positioning, if anything, has gotten more bearish here, would be the next window I would be looking for something to begin and be very cautious during.
And just in closing and in summary, going back to your portfolio for this last question, which is, if you could impart one lesson to your average investor around building your own portfolio, what would that be?
A couple of things. Look at cash flows again. Fundamentals will matter again. That the price of money is going up. And when the price of money goes up, I know that's a weird thing, right? The cost of money goes up. The value of those dollars, cash flows matter more. So it's not just that's not just discount rates. That's really understanding what has real value and what doesn't. Really matters. How far off the ground is that airplane that you're flying? Is going to be a real consideration. Even though for decades we've been flying very, very comfortably, continent to continent without any thoughts. That will matter again. And I know I sound like the mumbling man in the corner at this point, because value hasn't meant anything. But I think at the end of the day, money supply from central banks is the most important thing. And when that is turning, you have to think about what that means for all of your investments going forward.
Always super thoughtful, Cem, and generous with your time. So we really appreciate it. Thank you very much.
Thanks for having me. Always a pleasant conversation.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.